A quick thank you to all of you who have joined in to discuss today. Yash, please take the baton, sir.
Absolutely. So, for all those who are joining, just a quick intro on Prakash. I know he needs no introduction, but Prakash is a regular market commentator. His focused approach to stock picking from within the small and mid-sized businesses has helped a lot of investors build their own profitable portfolios over the year. Obviously, using fundamental analysis. His experience of having worked with ultra high network clients and family offices alongside retail investors has led to a keen sense of understanding behavioral finance that goes beyond just numbers when it comes to equity investing. So thank you so much, first of all, Prakash, for doing this and joining us this evening.
Thank you, Yash. Thank you for getting me onto this. It's a privilege and a pleasure.
Awesome. So Prakash, without wasting any further time, let's talk markets. So the last few days, the markets have been sort of in a seesaw moment. I know you don't look at charts and technicals, but one day it's a gap down, the other day it's a gap up, and then again it's a gap down. And you pick any newspaper, the headlines are almost brutal. Weak earnings, Fed almost ready to pull the trigger on a 50 basis point hike. China seeing COVID cases re-emerge and their zero tolerance policy and going for harsh lockdowns. Someday or the other, there is some Russia-Ukraine related news as well. So where do you see the markets headed now in the short term because of so much complexities that is there?
Yeah, no, absolutely. I mean, the current situation in the market is something that most of us are fairly new to, given that we are in a paradigm which is absolutely very unlike what we've seen all the past many decades that most of us have been active, or some of us have been active. So, the reason is, Yash, very simple. What's changed in the market is the flow of information and the access to information, the reaction times, everything has changed. So, even people like me who I don't look at charts, but I do refer to charts to get a sense of where things are headed or what are the levels that which could become critical. The simple stuff like your 200 DMA, 100 DMA and stuff. Even that is not mirroring the classical approach for the simple reason that earlier you used to have charts reflect nothing but behavioral activity related to a particular stock or an index at a particular level, right? So that's where the volume, participation levels and all would kind of start translating into your candlesticks and things like that. Now, these days, what happens is that the reactions are so quick that at every level, there's a very different and a very quick response to situations. And it's no more the classical approach, which was digested by all. It was fairly time bound. It had a finite curve in terms of reactions. So charts have also to be looked at very differently, and you instead of weekly charts or monthly charts, I think what's making sense is daily and hourly charts for some people as well. Especially for traders. But for people like us who look at fundamentals, the macros particularly are changing so quickly, and the markets respond to these even faster because the participation level is not selective. It's so wide ranging and so broad based. You have people responding to change in macros immediately. Look at quarterly earnings. Look at changes, announcements on data like IIP and PMI and stuff like that. It's so rapid. So that's one of the reasons why your response times have to be you have to be fairly agile. Or you take the sleepy approach of investing into the market and look at it after a few years and say, okay, this is what my stock has done or was expected to do, and that's when I look at it. So my take on the market situation right now is, first and foremost, it's not alarming. Though you have headwinds on the Fed rate hikes, which have been discussed a lot. So I'm not going to go into why that 50 basis points or why more than 50 and how many hikes in a year. But I'll simply explain. The market has two unknowns, and those are the danger points. So those are the points those are the elements of vectors which you are always worried about. The first unknown is a known unknown. Yeah, so which means you don't know when the Ukraine-Russia crisis gets over. You don't know what kind of trajectory the US Fed would take or what the impact on inflation control would be subsequent to the first few hikes. You really don't know how oil is going to behave. over the next 6 months. So these are the known unknowns, and that's what everybody tries to spend time trying to digest and analyze. The second unknown is the unknown unknown, which means there is something which you don't know about, and that could be something like whether the China COVID situation is a reality, or is it something that China is trying to do to curb other things, or exercise some sort of a control, civic control, to attain other objectives. We really don't know. It's a black box. So that's a real unknown. And if COVID in its fourth or third or whichever wave erupts, it's going to be very different and debilitating for the rest of the world. The other unknown could be the Taiwan China situation. So that's something which nobody has a clue, and it could kind of just happen. So those are things that you can't factor in or can't price in, and you only keep yourself on cash to counter those unknown unknowns. But the known unknowns very clearly give you adequate time to respond. And how do you respond to that? It's primarily by carving out your portfolio to benefit from those changes. So if crude is likely to, or could be, let's say, tending to go up to $100 or probably beyond, you need to look at things that benefit from crude and keep away from the crude impacted sectors. Something on those lines. So for me, markets from here, where are we? I think it's a great situation. People who have missed out on buying in 2020 or even early 2021 actually will get a wonderful opportunity to buy into Indian stocks when India is transforming itself and moving to a manufacturing focused economy from a services economy. And that's not going to happen overnight, and that will throw up immense potential opportunities over the next couple of years. So it's time to sow. This year is time to sow the seeds. It's not to reap. It's not to harvest. Harvesting will probably happen in 2025 or 24, maybe if you're lucky. But this is the time to just invest. So look for opportunities which are investable, not which are necessarily tradable. That you buy in and get out in just a week or two. Yeah, that's what I think the market is giving you.
So Prakash, in that sense, the question that we've put forth with the spaces is that, is it a buy on dip sort of a market right now? What would be your answer? Are you going and buying the dip, or are you staying slightly higher on the cash?
I think the dip is going to be fairly. Yeah, sure. That's a very important thing most of us grapple with, and we don't have perfect answers to that. But the dip is likely to be more broad-based. So what happened to technology stocks, let's say the first quarter of calendar 22, what's happened to BFSI could probably happen to some of the other sectors as well. It could be chemicals. I mean, you've seen some of the good names have got a drubbing because they're disappointed with earnings. So the market is very is punitive to a fault in that sense. The market is willing to move to other sectors because they offer better opportunities and not be seated in a sector which is not doing well or is just moderate and ended up having very rich valuation. Look at HUL, for example, in the FMCG pack. I mean, top of the line stock and everything is promising. It's come back to levels which it was almost a year and a half back. I mean, when they actually did the transaction, sometime back, and that 1900, 2000 zone was supposed to be the base. You're close to 2100. So those are things which happen very easily when the dip is more broad-based. So it will go from one sector to the other. It will keep on percolating to other sectors and to other names, not just leadership names, to the mid-tier names. And that's where, you get a very good bottom-up opportunity. So I would buy the dips in stocks, not necessarily the market. That's the way I would explain or answer your question. Would I buy the dips? Yes, I would buy the dips in certain sectors or in certain stocks, but not necessarily just because the Nifty is dipped 700 points from the recent peak or something.
Gotcha. Okay. Interesting. While Prakash, while we have Yash talking about today's markets, I want to talk about today's investors, the people themselves. Invest from anywhere with apps is a real possibility today, and apps are letting you to and you have ads on TV that show people sitting on their couch, lying down, wearing shorts and investing, and that's happening today, right? Has this changed the investing behavior and the mindset at all of new age investors?
Oh, tremendously, Ashwin, tremendously. In fact, the game has changed because the players have changed. Okay, people who today influence the market by their levels of activity, not necessarily the scale of investment, but I'm saying level of activity, which is how much they buy and sell. There's far more younger profile of people who have spent probably lesser time in the market than some of us have, which is fine because they've gone into the market at a time which was very interesting in probably the pandemic. At the start of the pandemic, 2020 is when most of them got initiated and interested. They had time on their hands, opportunity. As you said, technology has been a great enabler for democratization of our markets. You don't need to be known to somebody who could open an account for you. When I started investing years back, it was because I knew somebody in Dalal Street. I did an internship and I could open accounts for some of my friends, and that's how they invested in IPOs. And IPO forms was something that was in short supply. You had to pick up forms from the Bakra wala out of Dalal Street before they could run out of those. Yeah, so that's where it started. So from a scarcity to a all round 24/7 availability, we've seen a huge change in the this thing. Look at numbers from some of the leading brokerages like Angel One and all. 70% plus of their revenue is coming from people who have been account holders who have been less than 3 years with them. Yeah. Which is what does it tell you? That these are new people who have opened up account. Maybe they have not been they had accounts elsewhere, but with Angel One they have been around for 2-3 years and they contribute the maximum because the level of activity is different. So what will happen is, the good news is, if your stock that you have invested comes down because people are willing to sell it, uh, don't worry about it. There will be people who will be willing to buy it as well, who will come quickly. Earlier, it used to take much longer. So stocks that corrected used to languish for years together before they revived. These days, stocks come down, they go up as well, as long as there is fundamentals to back it up. And that's the beauty. Everything's happened faster. So the turnaround times on behavioral investing is faster. People don't have the patience to hold on for too many years. They get out within a year or so. So the nature of the investment community, constitution of that community is changed dramatically, Ashwin. So to answer your question, yes, it's a very different market, and you have to understand behavioral finance as much as fundamentals of companies and balance sheets.
I've been itching to do an entire session on behavioral investing, hopefully some other day. But just a quick follow on here. What do you make of influencers? I'm saying that with quotes, on since we are on Twitter Spaces, on Twitter and other social media platforms. What is your first knee jerk take on people who are spewing out advice that people are, soaking up in hordes?
I think that's because I'll tell you, I don't blame people who keep on putting out so-called advice or for and with a disclaimer that this is for educational purposes. I really at times miss out on figuring out what's educational about a certain piece of advice. Where somebody says buy it at this level and it could test this and go out and this thing, and what's educational about it? It's actually spoon feeding somebody who doesn't want to do his or her own work. And human nature is such, Ashwin. So we are born to be always figuring out the easier way, right? And in fact, most of the inventions in humankind has been because we wanted to find an easier or better way to do it, right? So the easier way is to look at Twitter, find out somebody who has a lot of followers, where you start resonating with probably the language or with the style of writing, not the content as much. And you say, okay, this guy seems to be reasonable. Let me see what he's writing. Follow it, ek do din dekhta hu, and then kind of start making yourself trade on those lines. Now
Right.
that's a very very simplistic way. So if there is an appetite for such influencing, influencers will always be around. So I don't blame them. If you try to influence something and people don't buy in, you can't survive for too long on Twitter, right? So the reason why there's so much of traffic in that pocket of Twitter is because there are takers. So people need to introspect whether it's good for them or not. If it's good, great. I mean, but I doubt if it's good. Conventional wisdom tells you that it's not so easy to make money just because somebody's posting a breakout chart or some sort of a explanation which is very simplistic, or which is very plaintive in terms of a rationale. So yeah, I mean, it's an easier way to lose money, not to make money.
Thanks for that. I do have something on this same thing, but I'll hand it over to Yash for the moment.
Awesome. Prakash, I know you track RIL very closely, and today is a huge day. Obviously, the stock is at a new all-time high, and it's the first listed company to cross the 19 lakh crore market cap figure. What really is driving this optimism, and do you see further upside in the stock from current levels?
Okay, so yeah, I mean, RIL is a stock that you can't ignore, irrespective of whether you uh, have it in the portfolio or not, because when it moves, the earth around itself also starts moving, right? It's a simple weightage that it carries. And the reason why the stock is in a new trajectory of sorts against the general sentiment in the market, Yash, is currently because a lot of the verticals that were not contributing, and it still made so much of headway from those 1100 zones to almost 22, 2300 in those 2 years' time. There were certain verticals like the E&P, for instance, which didn't really contribute anything. Or for that matter, the petchem segment, which is a large investment. If you look at their capitalization in terms of where they've allocated capital, one of the largest areas that they've been pumping money into, apart from geo and retail, which are new businesses and hence would require capital. So from a historic perspective, petchem has received tremendous amount of money, apart from the bread and butter refining business, which was also hum and ho, which kept on moving between GRM, which is margins, gross refining margins, tended to be slightly range bound. $10, $11 on the higher side, about six on the lower side. So it was very tight. Now, what's happened is, because crude has moved out of this comfort zone of $70, $75, or some people would say 60, 65 was the normal earlier, and now it's moved to the 90, 100 plus. Very clearly, the picks and shovel approach tells you that anybody who is into crude work and who is not selling crude necessarily or pumping crude out of the earth will also benefit, because all the other costs go up, or the value chain starts perking up. And Reliance is definitely going to benefit. Singapore GRMs, mind you, are almost double of what the last 5 year average has been. Okay, so this quarter you may not see great stuff, but coming quarter, Reliance will have tremendous benefits from its inventory gains as well as from the GRMs. And then of course you have gas. The E&P has started bringing itself to life from the last 1 year, last 4 quarters. Consequentially, they've actually moved up in terms of the gas output itself, which is tremendous value coming onto the P&L, which was not there earlier. And then, of course, retail also, there are a lot of headwinds which are now positive, in the sense the tailwinds of the future deal are over. All those issues are done with. You actually can go and very rapidly expand. And of course, telecom, we know how it is. So it's firing on all cylinders after a long, long time. Earlier, always used to have saying, kuch to gadbad rehta hai. One of the verticals would disappoint you. That's not no more the case. So I think Reliance has definitely taken leadership. And remember, ETF flows are going out of India. In spite of that, it's making lifetime highs. Just imagine what happens when the ETF flows reverse. An ETF that puts in $100 will have to put at least $11, $12 in Reliance, right? Whether they like the fundamentals or not. So when that happens, you will see more demand for the stock. And that's what could probably lead to a little bit of P multiple re-rating as and when that happens. I don't know when that happens, but it's definitely in the worst of flows, five flows, it has actually made new highs. So that's a great opportunity for people who understand flows and how momentum works in favor of fundamentals.
Prakash, I just want to follow up on this news that the deal with Future Retail fell through because the creditors did not approve of the resolution. Do you think this will have a significant impact?
It kind of, so okay. So I'll tell you, we really don't know what happened after the deal met with this roadblock. The fight with Amazon started. What they've done is they've utilized this time to iron out and move to Plan B. Okay, Plan A was to utilize Future Retail, the front end stores, which are definitely a big asset. Not as a great brand, but yes, at least in terms of presence, there was continuity that they could have leveraged on, which they missed out on because they couldn't do it as much as quickly as one would have liked. And the second part of the Future retail acquisition was Future had a very strong backbone of processing the supply chain side, the backend processes, which is important in retail. And that's one of the key reasons why DMart is so successful because they have a very strong backbone on the operation side, right? It's
Right.
when I say operation, it's warehousing, sorting, packaging, all the labeling, all that happens behind the scenes, which you don't see, and that's exactly what Future also had in terms of Future Networks and some of the other group companies. That is what Reliance had wanted to acquire and build on. And since that was not available because of this issue, there were hiccups. They actually moved to Plan B and set up an alternative, which I know for sure is already in place. And now these 900 plus stores that they've acquired will certainly change. In fact, they were low key. You could go to a big bazaar, the erstwhile big bazaar, and you really couldn't make out whether they were ये चल रहा है ये खुला है कि बंद है one of those question was there a few months back. Now the
Yeah.
wholeheartedly you will probably see that being leveraged in its full glory with the kind of product range that they have built on. And remember, we tend to ignore the other side of Future of Reliance Retail, which is got nothing to do with this impediment that we had on the Future transaction, and that is the high end brand acquisition that they've been doing. They've been adding one brand and after the other, and you go to Maker City and you realize the portfolio of brands that they have, and you walk into that fancy mall out there. It's absolutely stunning, so there is much more that's right now not visible, but retail will now pump on all this. And I mean, this whole retail thing will start taking a very new look, a new shape now that the stores are under their fold, and there's no issue or questions around where it's headed. So that clarity is definitely going to.
Prakash, I
Yeah,
think,
sorry.
yeah, okay.
Yeah,
No, actually, your voice drops. I thought there was some issue. All right.
yeah, no.
Okay.
Yeah, go
So
ahead.
moving forward, Prakash, so before you joined, we were just discussing how the IPO market is back in flavor. We've had two IPOs open in the space of 2 days, and obviously the big bang IPO, LIC, opens next week as well. Uh,
Yeah.
we have seen some cutback in terms of the IPO size being reduced to 21,000 crores. There's obviously huge discounts for policy holders, retail, as well as employees. What is your high level take on the LIC issue, and do you think that despite all the negative news flow around there, would it be able to sail through and see record subscription?
I don't see any hiccups, barring some black swan event on the market as a whole. And given the condition of the market, I think there is enough and more cash that institutions are sitting on. Remember, they were anticipating this IPO much before 31st March, and that didn't happen. So from that late March to late April, nothing much has changed in terms of allocation. It's not that institutions have come and poured money into the markets. In fact, if there's anything, they would have pulled out more, especially the FI. So I think there is enough appetite to buy into the IPO from the institutional side, and the anchor book will definitely be very impressive in terms of appetite and composition, of course. And it's a very small issue at this juncture. The company is huge. It's a giant that is offering just one small, teeny, mini bit of its ownership. And I think the government's also trying to make sure that it sets the ball rolling in terms of price discovery, in terms of interest, because there's nothing better than the market to tell the issuer what price you could fetch. We've seen what happened to IRCTC. The government came with an IPO at, remember the prices. You're probably happy to forget about it because the government would be happy to forget about the fact that they offered it at such low prices and then where it went. So those things happen. So they wouldn't want to err on that particular side. They've already reduced as per the expectation and feedback from roadshows, I believe. And people talk about this 13 lakh crore valuation, which was there. It never came out. It was just anticipation. So it's like, there's so much of stuff going around on the NSE IPO valuation, but you really don't know what it is going to come up with. Is it going to be $2,000? Is it going to be 25? People talk about 3,000, 3,500. So it's easy to do some kite flying and see what reactions people have. But I think the LIC IPO will definitely have a huge appetite. And this is the beginning of a very long journey with a very minuscule offloading of ownership. And there'll be a fairly strong price discovery after the IPO. So, you'll have to give it time for the price discovery to really be stabilized in that sense.
And what would be your advice to retail investors? Is it an apply?
So it's like this, LIC, the business very clearly is long term. There is nothing, and the price might, if there is anything, the price might just give you a little bit of a favorable upside. But at the current price, there is no risk of it crashing, right? So if you get allotment at this offer price, why not? And you're not going to get too much any which ways. It's not that you're going to get more than what you sought after or applied for. So you will get proportionately much lesser than what you applied, and you would get an opportunity to buy even in the secondary market. So here's a chance to participate in primary and secondary, both, to build even a simple small allocation in your portfolio. Right? Awesome. So you could apply. So specifically, I'm not trying to dodge the question. Specifically, I would say you apply if you are a long-term investor, but don't apply just because it's an IPO and it's going to be getting listed at some phenomenal multiple and you'll make some quick money. No, don't do it for that.
Well, that behavior has bit people in the recent past. So,
yes.
Prakash, one of the exciting things over the last couple of weeks is how everybody's saying you can invest in US stocks, you can own, Tesla, Apple, the works. How should investors really think about here when it comes to, adding international stock into their portfolios? And also, are there any risks here that are not immediately visible that investors should, just keep at the corner of their head?
Oh, absolutely. I think, Ashwin, the participation levels in stocks in India is far more benign, far more stable, level-headed than, the nature of participation in the US stocks. I mean, I have advised clients on international equities, and when you say international equities, 50-70% ends up being the US market, right? US stocks have very complex behavior. The price behavior, not the companies. The companies are stable. You saw the Google results just a couple of hours back. I mean, it's a huge upside. Everything's going on well. There's nothing to complain. But the stock price behavior is something we can't fathom. And we have precious capital. I mean, you are allocating just barely $250,000 in a year. It's not that you can do too much, in terms of that. So it's something where the sex appeal of investing into US equities is high in that sense, but it's not something which is going to be very creatively rewarding for you at this point unless you follow the market very closely. Yeah. So buy into companies which are slightly boring and out of favor or out of the news, and which have very strong fundamentals. So I remember we got people to buy into gold mining companies a couple of years back for our clients, and that did exceedingly well because gold was on an upswing. The pandemic had just kind of started, and we figured out gold always does well in these situations. You have so many companies that were doing surgical, where you had hospital supplies. There's a company which makes hospital beds in the US, and when the pandemic started, it was available at a P multiple of 3.8. Very small company by US standards, but decent enough for us to invest. In terms of market cap, it was probably close to about, I think it was about $120 million. So, it was regarded as a micro cap there, 120, 140 million. And there you had the opportunity to buy into something which was definitely going to do well, and it became 5x in 2 years. So those kind of things will happen. So look for businesses that you can't participate in being in the Indian equity markets, and certain sectors are way ahead out there. So biotechnology, if you understand a bit or you work on that, and there are people on Twitter who do educate genuinely a lot in terms of writing threads on some of these businesses. So there's a company in Taiwan or somewhere in the Middle East, in Southeast Asia, which does battery swapping, right? And When you look at Gogoro or something, that's the name. If you look at their model, it's so promising. If you could get a chance to participate in that, or the Taiwan Semiconductor Company, those kind of things are definitely worth investing into. You could buy into cybersecurity. There are so many companies. We just know the Palo Alto stuff, but there's below that there are so many players who are in cybersecurity. And if digitization is the way forward, you will have cybersecurity that's going to do well. So sectors you don't have available with you, and you can participate by investing into international equities. Yes, definitely look at that.
Excellent. And also, can I take that there's a takeaway that don't get excited and jump into it, and go a little more cautiously than you would approach the Indian market, simply owing to the complexity of the way those stocks are structured.
Yes, true.
Perfect. Awesome. Yash.
Yeah. Prakash is sticking with the global theme. For the past 10, 12, 14 years, the Nasdaq has been in a secular uptrend. But look at the results. Like you said, Google. There was a miss by Netflix as well. So the kind of moves that we are seeing in names like Facebook, Snapchat, all these other tech companies, Peloton, it's extremely scary. And
Yeah.
yesterday or on Friday, the US markets closed at their lowest level since almost November or December of 2020. What is your view on tech stocks and in general on US markets in the current context? Is the worst already priced in, or could we see further erosion in these tech names?
So Yash, it's a complex environment for tech stocks. I mean, honestly, there's no broad brush solution to figure out what's likely to happen to the sector, because the sector itself is so diverse, right? I mean, when you compare an Alphabet to something which is, let's say, Netflix, I mean, they are two very different solution providers or service providers, and their behavior will be different because the audience is different, the TGs are different. And these tech stocks, I mean, look at Zoom, like it's a classic example, and there was enough floating
Right.
around on Twitter elsewhere where we keep on seeing this magical chart where Zoom has come back to the pre-pandemic level. So and Netflix is the same thing. It's talking about losing subscribers. There was a joke going around. I was talking to my mother-in-law, and I say, the reason why Netflix is down is because all of you have figured out a way to use the password effectively, and secondly,
Share
uh,
account.
rest of the people who actually were paying for it and using it on their devices very diligently have actually got busy with work again. So so I know for sure a few people I know in my family and friends, their Netflix accounts have expired and they've not bothered to renew it, and they say, okay, we'll do it maybe, I'm undergoing a little bit of a stress on work, I'll do it once it's kind of easier. So that's going to happen. That's going to happen. But hello.
Yeah.
Yeah, so that's going to happen where tech companies will undergo very rapid shifts in their consumer segment, in the underlying consumer segment. Now, if that is going to happen, whatever premium valuations we had accorded to them as if the pandemic was a permanent feature, and we kind of started extrapolating linearly, saying, oh, this has happened in 2 quarters, the next 4 quarters look so promising, the next 5 years look so promising. But it's not the case. The behavior of the target audience is changing so dramatically, it's normalizing so dramatically that things will change. So if work from home actually uh, kind of moving to a situation where you are doing other things, or you're going back to office and traveling is begun, the nature of your consumption is going to change, right? So all these 2 years, for example, suitcases, companies that were making luggage never got any upside. There will be a huge pent up demand for that. It's not a recommendation, just to kind of be clear, but I'm just giving it as an illustration that we can kind of, shift things very easily. I mean, things can shift very fast, very rapidly. So tech companies which had got exorbitant PE multiples will normalize. It's just a case of normalizing expectations and the PE multiples. And in that sense, the digital the adaptation for digitalization is going to be absolutely at its peak. In fact, it's going to be much faster because people who have been on the on the fence, sitting on the fence and trying to see whether it really makes sense, have actually seen the difference it has made. And when that happens, I mean, for example, you guys have come into India because the environment is more conducive, right? I mean, you've seen that happen. So it's very clear that this is going to be very rapid, and tech companies which are leveraging on the consumption, which is more visible and long term, will continue doing well. So an Alphabet or an Amazon, I don't see any disruption there. But things which were only pandemic driven will
Mhm.
definitely have to go through a little bit of a soul search. Yeah.
All right. So coming back home, Prakash, a lot of retail investors have actually missed the bus when it comes to the Adani Group stocks. Are you buying any of them? If yes, then which one and why?
No, I don't think I have. So it's like I was also one of those who was waiting at the bus stop. But when that particular bus came, I realized it was the ride could be too bumpy for me. So I would rather wait for something that is, those non-stop express bus services vis-a-vis the regular stop at all stops kind of a thing. So I prefer that. I know in hindsight it looks like because it was an Adani company, it has done well. It's not the case. They have got themselves very well timed in the businesses that they ventured into, and mind you, it's not something that's overnight. So, for instance, recently they acquired there's a business called Ocean Sparkle, the company they acquired, which is into a lot of port-related services. Now,
Right.
they understand that business for a long time. What they're doing is they're getting integrated, backwardly well integrated into the business. So Adani Ports has definitely been around. It's one of the oldest of the group companies. And they're buying companies to suffice for the backward integration. In certain cases, it's forward integration. So I think their plan is to keep on scaling up within the value chain that they are present. It looks as if they are getting into everything, but it's not the case. It's not the case today. If they were to buy a new business which they are not into, and I'm referring to something that's in the air in terms of a discussion with some large international players who have businesses in India and who would be willing to sell to a domestic player, could be Adani, could be somebody else. That's because they consume that product, that commodity, so much in all the businesses, right? So and they can be present in that value chain in some point. So I think you have to understand that the businesses have a lot.
Uh,
D-
I think, yeah, I think
Prakash, we are
there's some.
losing you, Prakash. You were loud and clear, crystal loud and clear, and we're suddenly losing you.
I hope he's able to connect. By the way, any idea on who's won the toss? Who's batting?
Good
What's the
question.
IPL team?
We should give regular updates during this session.
Yeah. But Prakash, can you hear us?
Well, Hyderabad are at 26 for 1. Oh, that's not too bad.
Okay. I think.
That's phenomenal compared to Bangalore, of course. Yeah.
What a shame, yeah. He was answering so well. I really wanted to hear him complete it. Okay,
Well,
we'll just wait for him to quickly join back.
I think we should
I'm
just wait
not
for
so
him.
much of a just a small confession. I'm not so much of a cricket fan. More of a football guy. There was a sick match last night between Manchester City and Real Madrid.
Yep, we've got Prakash back on. We just need to bring
Yeah.
him back to the conversation fold. Check, check, check. Prakash, if you can just send us in a request that you should have from the left bottom corner, we would be able to quickly bring you. Yes, you're back in, Prakash. Welcome back.
You're on mute, Prakash.
Yeah. Can you hear me now? Yeah.
Perfect.
Yes.
Loud and clear. Welcome
Yes.
back.
Sorry.
Please go ahead and complete your answer. It's a shame the Twitter Spaces thing hung up on you.
I know. No, no. It happens when ownership changes. Okay, so
Ouch.
I was saying, it's good to from a fundamental perspective, the port business is still very promising. I don't see any let up in terms of the growth on volumes, ability to handle far more superior metrics of cargo and whatever. But the other businesses, some of them seem to be now grossly overvalued, right? from a positioning perspective in terms of where the business is and what you are according as a PE multiple. For instance, the recently listed FMCG business is extremely promising, but uh, whether you want to pay this kind of a P multiple or not is a big question. And I think that's the reason why if you didn't participate at what seemed like high P multiples at the listing, these multiples only look grossly higher, right? So the answer is, of course, you have missed out. But whenever there's a new business that gets comes for listing, you will probably be able to assess and participate. Is my guess. But at the juncture, at this current juncture, I think not so much value that resides in most of the businesses from a price perspective, except for ports.
All right. Prakash, let's talk about the earnings season. It's underway. Sort of a mixed bag, more so on the misses rather than beats. We had Bajaj Finance report earnings yesterday, and the stock was down almost 7%.
Yeah.
IT names haven't delivered that great numbers. What is it that has really stood out for you, and what are you pricing in terms of the earnings for FY23?
So earnings, honestly, quarterly earnings are a very difficult metric to use to decide in terms of allocations. What it does help me usually is in two things. One is the stocks that we are invested into, are they doing fine on the lines of what you had built as a premise, as a anticipated trajectory of growth. If that's the case, you just stay put and let the business be run as it is. Or if you are looking at some evaluating some businesses, I tend to look at quarterly earnings at least 3 to 4 quarters, or maybe at least 2 to 3 quarters before committing capital to a business that I've identified, just to make sure that I understand the earnings better. It's not whether the company is doing well or not. The company does its own bit. So, but if you start interpreting quarterly earnings and you get that comfort and conviction that yes, there seems to be something promising, then yes, that's what quarterly earnings are best used for. But otherwise, on the basis of just quarterly earnings, you may not be able to pick a stock unless you are a trader, which I'm not very efficiently and honestly. But I would believe today's scenario, the earnings season has opened up a lot of opportunities by telling you that companies are continuing with the good work on deleveraging their balance sheet, and usually the March end quarter is significant in terms of those actions. The Jan Feb March quarter earnings are always used by companies for balance sheet direction setting, or balance sheet assessment, or balance sheet repair. And if you look at from that perspective, a company that recently announced, and that because it's on the top of my mind, because it was recent, was Tata Communication. Okay, the results were disappointing from an expectation perspective, not from a business perspective, because the business is fairly complex, the environment is challenging. But given the impetus on digitization and the way data and all of this communication is changing, the landscape is changing, they are well equipped to leverage on that, and they've deleveraged themselves in the last 2 years. They've reduced debt by almost 2,400 crores in 2 years. Even this quarter, there's been significant debt reduction. So if that is the goal and they're moving more closer to that direction, in that direction, and in the process, they've probably missed out on a couple of P&L items. It's fine, because the market's given you an opportunity to buy into a company for the future, not for the quarter gone by. So I think those are things that we'll look at. And so for example, on the other side, just to help people understand how results can be interpreted differently, GMDC reported a stellar set of numbers, right? But the stock is already moved up so much in anticipation of the changes that are happening, that everything and more was priced in. So it probably did. Whereas Tata Communication, the numbers were decent, but people had much more high hopes, and it disappointed in that sense. So that's why you got it. ICICI Bank, stellar set of numbers, quarter on quarter, such a lot of improvement. The market's not in a mood to reward it. So I think those are opportunities to get in. Good numbers, bad reaction. Yes, that's where you look at adding more to the portfolio.
Lovely. Prakash, I know we have about just 8 more minutes of your time, and I want to take a small detour from the market talk,
Yeah.
and really want to ask you about you. Give us the method behind the work you do, Prakash. How do you do your research, your sources of information? Net, how do you keep yourself sharp?
Well, you see, the attempt is to follow stock bits, of course. So the attempt is to make sure that you actually do what is called research. What's happening is, unfortunately, fortunately, most people end up doing search, and they make themselves believe that that was research. Okay, so I get a lot of questions asked by people who follow me, or write mails and saying, I've figured out this company from Screener, and everything looks so promising. So my answer to that is, if it is already featuring on your search in Screener, or in any other platform for that matter,
Right.
it's already done its bit, and the market's already discovered. It's probably more discovered than you think it is, and it may not give you the upside, but it just gives you that excitement of having figured out a company with very strong metrics. So I look for my method of going. The starting step is to use filters where companies are still not doing well, whereas the sector is doing better or has seen the change bring about itself. For example, I'll give you an example: textiles. There's
Okay.
so much. There's so much happening in textiles as a sector globally, and the participation that India is likely to have and is having. But the companies haven't started doing well, necessarily. So you need to look at companies with still bad figures, but which have the potential to do well. So about 2 years back, we had identified a company called Nitin Spinners from the sheer size of the investment that they had made. It was available at a market cap of 700 odd crores, 600 odd crores, whereas they had done a capex of 700 crores. So you can imagine, of course, the EV would have been 1300 crores in that sense, but the 700 crores that went into investing capacities would start throwing some benefits, right? So it was a
Yeah.
strong business, and from the 60 or whatever zones it was, it has moved at least 4x from there. And that's exactly where you find value. So my way of looking at is not search. Research is about going one step uh, below that threshold of just data availability, or looking at just certain screeners and all, and figuring out what this company is doing right in a sector which is looking promising. If it's a very simplistic way, but if people are looking at EVs, for instance, it's a very hot topic. EVs, there is no particular leadership that's emerging on EVs, but there are a lot of people who are making sure that EVs leaders will become leaders, and that's through the battery business, or that's through all the ancillary business. So you look at those things. So I think my approach is very commonsensical. There's no modeling of sorts. I don't have a particular this thing. I track companies just to understand the business model. And as a rule, I used to, now I don't do it very often, but every day I would open up one company's website. It was a rule. 200 days in a year, look at a company website. In 2.5 years, you will do the BSE 500, right? Uh,
Yeah.
Right.
Now, and it doesn't take, one company website in a day makes you so familiar with that business. And that's one of the reasons people a lot of times ask me, saying, you get thrown a question on live television about something, and what is it that helps you respond to it? It's just that homework. It's just that homework. Those, and both you guys know how it works. For those 6 minutes that you are on television, you need to prepare for 60 minutes, right? So
Yeah.
Yeah.
that 60 minutes is what you prepare is very simple stuff. A lot of people are in the market trying to find companies, buy into companies that somebody's recommended, but they've not been to the website. And once you start looking at websites, you start realizing the nature of the business, the response levels. There are companies where the first pop up that you get is a sales inquiry, which is superb.
Yeah.
I mean, there's a company that's willing to use his website for more sales, and not just to articulate his vision and history and mission and all, which is of no no significance to ad business, but it changes the whole paradigm of what this company is doing. So unless you do your research and not search, it's very difficult to identify or find those kind of businesses. And don't be worried about market cap or stuff like that. In fact, low activity companies are dangerous because you could get trapped into it and all that. But if you are the one who is creating that activity in a low activity company, don't be worried. People will come later when the value is discernible, when it's visible. So, whenever you name a company to a co-investor or to a family member or to a friend or colleague and say, I'm looking at this company, kya lagta hai? And the guy said, oh, no, not no, this one. I've not even heard of this. Great news. So it's like that. You will always make money, especially in bottom up stock picking on micro caps and small caps, uh, by by painfully doing research for a longer period of time on businesses than large cap companies. Large cap, there's so much information available that in 2 weeks you can get so familiar with the business and start sounding like a rated analyst. But small companies, there's nothing much available. So scuttlebutt, a lot of reading around it, and there's basic stuff, annual report, and all that is given. There's nothing very great about reading an annual report. It's necessary. It's not an optional thing. But yes, to answer your question, the method in the Magnus is to keep it very simple, and the starting point is familiarization with the businesses, various businesses, business models of companies, rather than straight away digging into financials.
Lovely. Research, not search. I'll keep that in mind. Thanks for that.
Awesome. You mentioned about visiting the company's website. You deserve an award if you go to the IRCTC website and navigate through it.
Man, it's not as bad as you're making it. It's way improved. Take my word. I keep using it fairly often. It's not bad at all. So
It is exaggerated just like the ITC memes, but it's fun, right? Prakash, you touched on EVs, and actually, coincidentally, my next question was on EVs. Looking at the recent unfortunate events, do you think that the shift to EVs, that whole narrative may be a bit exaggerated, and could auto stocks make a comeback in FY23?
The auto stocks will definitely make a comeback, and they are making a comeback. I mean, if you see in the last 1 month itself, we have managed to do much better in terms of what some of the large cap autos have done. And the next phase is, and I'd mentioned this sometime back, that you look at a company like Apollo Tires. It's announced a price hike in the first week of May, and a tire manufacturer who's dependent on OEM absorption will only dare to do this if there is some likelihood of demand being still intact, right? I mean, they won't just talk about a price hike and say, oh, sorry, it didn't work, right? So it's very clear that there are very clear signals that the auto sector, conventional auto sector, uh, will start bouncing back, and this is global. It's not just a domestic phenomenon. So that will happen. But the EV side of the business is so rapidly evolving every day. There are more people working on EV technology than on auto technology. In the past have ever done. So, for example, let me explain this. The number of people who are experimenting with launching EVs is far more than any other manufacturing that is right now available. I mean, I know companies which are as small and in markets as small as Rajkot and Baroda and Ujjain and all, who are trying their hand at creating two-wheelers, battery-driven two-wheelers. Now,
Yeah.
battery-driven two-wheelers are very simple to configure and assemble, but they're very difficult to sell. They're very difficult to service. So the challenge that most people are forgetting about, and safety is another angle that I would add to it, right? We've seen that in recent
right.
past.
Yeah,
So
it's opened up a
if,
can of
if
worms in itself. Yeah.
yes, absolutely. So, because it's a new area, uncharted territory, the standards haven't kind of come in or got, adapted. It's a huge evolution that's in the making. My way to play on this is going to be anybody who starts, again, the picks and shovels approach, right? I don't want to go and dig gold. I want to sell the shovels which all the gold diggers will need to buy. And from that perspective, KPIT was a great buy, and it's still probably doing, the numbers tell you it's so promising given the margins and the growth that it is clocking. Because people will need these companies, Tata Elxsi, KPIT, are companies you can't ignore when it comes to solving your EV powertrain solutions and all that. And the same thing goes for the battery side. But unfortunately, there are very few listed players in that. But there's a company called Cabra Extrusion, which has got a battery arm, which is not talked much about in public. But I mean, of course, it's part of the listed entity and everything. So you could look
It
at
was
that.
the recent acquisition, right?
Yes, a couple of years back, the management ventured into this, tied up with an Austrian company called Batrix. The
Yeah.
brand is called Matrix, and they're doing exceedingly well in terms of the work that is being done, the kind of OEM partnership that they are experimenting with, and all. So, and of course, in the last 1 year, the stocks also moved up significantly. I'm not saying that there's still huge upside, but I'm saying those are companies worth tracking and researching if you really want, rather than saying Maruti will do EV first or Tata Motors will do EV first. I mean, that is that is that's a very different this thing. So there's much more to EV than what we understand. It's not so simple. And I would suggest anybody who wants to buy into an EV related business should go and visit uh, a company that makes these, or try to understand some of the components of this value chain. So uh, it's like very few people have actually opened out and held a battery in their hand to figure out what's the difference between a battery and another.
Yeah.
So so let's face it. In fact, my son never could figure out why batteries are required in cars, in conventional cars, to switch them on and off. It's saying what's the purpose, so so those are questions that a lot of people have, and we understanding will have to go through that learning itself before the industry becomes investable in that sense.
Yeah, and slightly off topic, but I was actually seeing this video on YouTube the other day about how these batteries are made, and this whole green pledge. At the same time, there are kids working in mines in Congo, which has the largest reserves of lithium and cobalt, which is used for making these batteries. So, is it really making any difference to the environment? These blood batteries and stuff like that. So that's also
Yeah.
a completely different side to this whole discussion and
Yes.
this whole concept.
Oh yes, no. So you're so right on that. Actually, there's going to be a time where a lot of this so-called thrust on renewable is going to get into a questionable zone. So, for instance, solar power, you really don't know what happens to panels after they have completed the biological life of 5 6 years or whatever. Where do they go? How do you recycle them? How much is recyclable? We don't know. So there's going to be a lot of questions which still remain unanswered on this. And ESG is ESG was used as a great tool to garner funds by large institutions globally, but it may not all be as true to itself as it sounds. So you'll have to let it evolve and come to a more realistic situation to invest in.
More ways to load up on IT stocks.
Yeah.
Perhaps. But sticking to this whole energy and power theme, we're seeing that there are multiple reports indicating huge power demand, and several parts of the country are facing shortages or blackouts. How are you looking at this whole power slash energy space, and which are your top picks from your?
So it was something that has been so visible in terms of what's coming. So I'll tell you why. Because the last many years, certain sectors give you enough visibility where the gestation to set up greenfield projects or are not what do you call greenfield projects take much longer, right? So, for instance, you have no new power project, conventional power project, or thermal power project that's come up in recent years. No, I mean, new capacities except for incremental brownfield expansions. There was a time when we saw the Adanis and the India Bulls and the Tatas and the Reliances of the world put in huge power projects. After that, 7 8 years, nothing has happened. So naturally, suddenly when you realize that the country's economy is coming back to life, manufacturing is coming center stage. You don't have supplies. So what's going to happen? You cannot set up a power plant immediately, and the whole thrust on renewables, which was supposed to fill this gap, has taken its own time because of dynamics on costs and availability and things like that. And you'll be surprised. The 1st of April onwards, the entire cost of putting up solar panels is changed, importing solar panels and all of that because of a duty change. So it is now not so profitable as it was to set up solar plants, which you could do till 31st March. So there's a lot of change in all of that dynamics, which the government will surely relook at. So we are probably 65% of our targeted capacity from renewables on solar. There's a long way to go. But my way to look at this play is there are some niche players who have mastered the art of getting land rights, right of ways, what it is called, when they set up solar plants. Okay, solar plants need a lot of land acquisition. Remember that, whether it's through lease or outright purchase or rentals, it depends on different models. But you need land to set up a solar panel or a set of solar panels, and
Right.
that right of way is something which is very complex given the complexity of land legislation in India. Right, the land laws are so complex, they differ from state to state and things like that. So companies that have the expertise or acumen to crack that have done very well. So likes of Tata Power. There are some smaller names also which are there. So there's a very small company which has recently changed its name from KPI Global to KPI Green, and they have been doing a lot. They started off 3 years back with a project to do 15 megawatt. Now they are 100 plus 115 megawatt. So those are things that have quietly happened, and there will always be companies that will go that path. So my sense is power deficiency in the country is an opportunity for a lot of people who can bridge the gap quickly. If they set up a greenfield project and take 2 years to do it, you don't make money by investing into that. It's too late, maybe by the time they come with the power supply. But people who can incrementally supply, so let's say a CESC, and just a case in point, I mean, it's not a recommendation, but I'm just saying the CESC business has got power production, power supply as well as distribution under its fold. So that could happen. Torrent is something which is scaling up very rapidly, making sure that it can do that. So use this opportunity to do investing into again the metering systems, the people who supply ancillaries to power businesses, whether it's step up, step down transformers, motors. There's so many other things that go into setting up the value chain, and last but not the least, coal. Right. So we have seen how coal has behaved. So and I had put Coal India out as a recommendation sometime at about 147, 148, just a few months back. I was talking to Nigel on one of the shows, and I said, coal is ugly, it's dark, nobody wants to invest into it. But here you have an opportunity which is driven simply by the demand dynamics, which could take it forward. Coal India could go through a re-rating, which Steel Authority of India did, a few years back. So that's the kind of potential it has. So those are things you play rather than just a pure play power producer. That's my take on this. But the sector is definitely very promising, given the long nature. So it's like real estate. 4 5 years back, no, in the last 5 years, there's not much of inventory that's come into the system, and that's why whoever has partially completed inventory or who has a balance sheet to complete projects quickly is benefiting hugely by the surge in demand, right? So that's what happens when there's a pent up supply disruption, whether through dynamics of demand destruction or raw material input. So autos is a classic example which we are going through.
Yeah.
Semiconductor shortages have led to a slowdown in output. There's not much of demand destruction as yet. So when the shortages are over and the supply comes back, you will see huge change in the dynamics of the operating leverage that these companies will have. What I mean is they'll sell more with the same fixed costs, and that will make margins come back, and all of that will recover, whether it's M&M, whether it's Maruti, whatever. So that's bound to happen sometime soon.
Awesome. Ashwin?
Yes, sir. My follow-on question really was on something that we were speaking a while back. Prakash, I am from a generation that looked at TV tickers. My father comes from a generation where he looked at newspapers for his understanding of what's happening in the markets, and we have people who are going by phones. Now, is this generation slightly more aggressive when it comes to looking at the markets compared to the other two generations of people who had slightly more antiquated technology to help them, make a call and decide?
I am still trying to straddle between the two styles of absorbing information, honestly, Ashwin. But what I find at times the mistake we do when we look at digital sources of absorption of information or input is that we tend to be rushed into decision making.
Right.
Whereas when you look at a newspaper, I had a nasty habit of pockmarking my newspaper with such a lot of things highlighted, and here, with a pencil or whatever I could lay my hands on, with the hope that I would reread this at the end of the day when I come back from work. And 9 out of 10 days I would not do it. But the fact that I was focusing on what to highlight got me to register a lot of those things, right?
Right.
And
Yeah.
those are the things that you regurgitate when you need to in your thought process when you're modeling something around the around that explanation. So and I can tell you, it's so simple. You read something, you register much more, right? Visually, it's much more the same. When on the digital screen, if you are kind of flipping through that, you have pop-up ads somewhere, and that's one of the reasons why I always subscribe to paid channels of information, which have pay this thing walls, because at least you don't get distracted with something else. Otherwise, you tend to be looking at an ad of an IPO which you are least interested in when you're reading something which is sinking from your portfolio. So it's kind of the noise element is much higher to answer your question specifically in the second approach. So if you have the ability to cut the noise out, fair enough, you can still thrive, but I think it's difficult. The classical way of reading a newspaper is still very strong, but I honestly don't get time to read the physical newspaper, because by the time it's come to my place I already moved out or whatever. And last 2 years we got used to no newspaper also, right? So
Right.
uh, but you can still read it on your iPad, on your handheld devices, but from the paid websites of these newspapers, not the push notification driven stuff, because push notification is something which they are pushing you to read. You maybe not necessarily good for you. So that's a slight difference. That's a great investment that people can make in digital media. This thing buying. Sources of information are commonly available, but some of them which you pay for will always hold you in good stead. Is my personal experience. Yeah.
It's interesting you say this because we think there's a larger problem at play, because when you pick up a newspaper, you read news that might not be directly important to you, which means your spectrum and horizon of the information that comes in is greater. But websites and AI and all this technology, you read one kind of story, you click on it, the machine on the website assumes that you want to read more
Yeah.
stories of that kind, and they start loading you on a certain sector or theme, which automatically silos your reading dramatically. uh,
Yeah.
a problem that we're trying to fight, but the tech guys always come back and say, no, 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 retention on people on websites is important, so we'll give them more stories they like, which is causing a larger damage in my opinion, but that's a different argument and a discussion for a different day. But thank you for this, Prakash. Thank you for your insights on this one.
My
Also,
pleasure.
also you need to have like-minded friends, because whatever you read will get recommended to them as well, so they'll start seeing it as well.
It's an
Yes,
echo chamber
yes.
problem. Yes.
That see the AI takes for granted that you are low on I, so that's why I am here. Okay, so what happens is you are being lazy, so the AI takes charge of your decision making, or nudges you to take those decision making, right? So in fact, there are a couple of these books which very clearly tell you. So there's one called Geometry of Investing. It's on behavioral finance, and even factfulness. Those books, when you read, you realize how much all of this can influence your thought process. So it's best to just analyze a company on a standalone basis, without the luxury of asking somebody else for an opinion. Whereas
Right.
AI tries to bring in something which is almost like an opinion to you, right? I mean, as
Yeah.
Ashwin said, your thought process is so siloed that you start believing very highly in a sector that you have discovered, because suddenly every time you open your phone, you read an article related to that sector and say, wow, everybody is looking at it, looks like, and there you so you end up investing in a sector which probably is still a long way to go in terms of creating that buzz, and then you keep losing patience and you move out of it at some time. So yeah, it's not something which is very very discretionary from your perspective.
Yeah, which means that we're on Twitter. I think if I must make it relevant and known to people that there's a possibility of changing your timeline from what Twitter thinks you should read to the chronological feed of stories that are coming on your list. So you can toggle that. Please use that toggle. I think it's a way better way of consuming content than depending on Twitter to tell you what you should be reading all the time. And same for other platforms as well. So yeah, end of my discussion there though on this topic. So
And also follow the right people like Prakash.
Yeah, no, I don't. So, Yash, unfortunately, or fortunately, I don't use Twitter to talk about stocks as much because I keep on doing it all the time elsewhere. So it kind of gets too heavy for me and people who follow me saying, okay, the same thing I'm going to parrot here. Why do it? It's a different platform. Of course, there are people I really admire in terms of the contribution that they continue to make. In terms of educating, genuinely educating people and sharing inputs. So I think there is enough good stuff to ignore the not so good stuff on Twitter, and I wouldn't really complain on that count. But yes, I'm not too much of a stock discussion person when it comes to Twitter at this moment.
Awesome, Prakash. Thank you so much for doing this and sharing your thoughts on markets and all things investing.
And this
Sure.
is one of the most candid conversations we've had in a very long time. So I highly urge you to go back to this and listen in if you want to really understand how Prakash thinks and his perspectives on, well, not just independent sectors or companies, but largely the behavioral aspects of investing, which could resonate very largely with how you are thinking about when it comes to investing as well. So I think there's a lot more takeaway beyond just looking at sectors and markets and how everything is jumping up or down. So yeah, thanks for that, Prakash. Really, really insightful and fun.
My pleasure, guys. Absolutely happy to do this, and all the best. I'm sure it benefit a lot of people who also need the right content to get their journey to be much more fun and adventurous and interesting. Yeah, absolutely.
Awesome.
Indeed. Thanks again. Take care, folks. And thank you again, Prakash. Thank you, Yash. We'll catch you all
Thank
back
you. Thank you.
very soon.
Bye bye.
Bye bye.
Bye bye.
Awesome, guys.